is coming through, and we shall make a start. Okay, good evening everybody, and welcome to Oanda. My name's Simon Clark, and I'll be presenting the webinar this evening. Now, this evening's webinar is part 4 of the Forward Thinking Traders program. This is the Precision Strategies section. So we're going to be taking a look at the trading strategies. We're going to be pulling all the information together that we've been talking about over the 3 sessions so far, and we'll be talking and giving you those trading strategy rules. What I'll do is I'll flag up the sort of pages that you might want to take a screenshot of that have got the trading strategy rules on there, so you won't need to actually copy those down as we go through. There will be quite a lot of participation through this section, and after we've taken a look at the strategies and after we've worked through those, then we'll go through some trade examples. So quite a bit of participation as well. As we're on for 2 hours this evening, we will aim to have a break about halfway through, just so that we can keep refreshed and keep focused as well. Now, I like to try and make these sessions as interactive as possible, so if you've got any questions as we go through these sessions, then please feel free to pop those into the questions box, and I'll try and cover those as I go. If they are more generalized questions, not related to any particular topic that I'm talking about, then feel free to keep those until the end, and I'll gladly sort of try and answer those at the end for you as well. Okay, so we've got 2 risk disclaimers which I need you to take a notice of this evening. The first one here is from Trade with Precision. If I could just ask you if you could take a quick read through this and make sure that you're comfortable with it. In brief, what we're saying here is that all information that we provide on the webinar is for information purposes only. Trade with Precision and myself, we're not financial invested advisors, or we don't recommend any particular security of any particular kind. Investing in financial markets is risky. You need to make sure that you understand the risks prior to implementing any trading or investment decision. Okay, so we'll move over to Oanda's risk disclaimer now. This one reads, as leveraged trading carries a high degree of risk, since you could lose some or all of your deposited funds, you should carefully consider your financial objectives, level of experience and appetite for such risk prior to entering this market. Most importantly, do not invest money that you're not in a position to lose. This presentation is for general information purposes only and does not take into account your personal circumstances. It's not investment advice or an inducement to trade Forex. Examples shown are for illustrative purposes only and may not reflect prices or offers from Oanda. Please remember that you're solely responsible for determining whether Forex trading or a particular transaction is suitable for you, and for seeking professional advice accordingly. So please make sure that you're comfortable with these 2 disclaimers and you're comfortable with the terms for continuing. Okay, so before we get into the main content, I just want to give you a quick introduction to the 2 organisations that are represented on the webinar. First of all, we've got Oanda. Now, Oanda, of course, was incorporated in 1996 and was one of the first companies to offer fully automated online currency trading. Now, since then, the company has grown considerably and these days handles more than 1 million queries every single day. Now, they launched FX Trade back in 2001, which is a platform that enables retail and institutional clients to transact business. Now, this is a very good platform. We've actually done some, we actually use this platform ourselves for the market commentaries and for the live market analysis webinars that we run. So do join us on those webinars if you want to find out some of the tips and tricks and some of the features that we like to use as traders on those webinars. Now, Awanda's won many awards over the years for their service from within the industry and also from client services alike, such as Best Trade Execution Provider, Best Retail Trading Platform, and Best Mobile Trading Platform as well. Now then we have Trade with Precision. Now, Trade with Precision was founded by head trader Nick McDonald. Now, he formed Trade with Precision back in 2006. At the time, he was living in London. He was a private trader, and he developed his own trading methodologies and his own trading strategies, and he was doing very well. Now, his broker at the time could see this, and they approached him and asked him if he'd be prepared to share his knowledge and train some of their other clients which weren't doing so well. The fact is, I mean, brokers want to see us as traders do well. The more we succeed, the more we trade, the more the brokers succeed. So it was in there, they've got a vested interest in seeing their clients all do well with trading. So that's what they approached Nick for. To cut a long story short, he enjoyed it, he did it, and Trade with Precision was born. Now the company's grown since then, and we've now got a small team of private traders that are scattered all across the world. And what we do is we just share our knowledge through that we trade, share our own trading strategies and our trading knowledge through our education programs. And we've teamed up with quite a lot of corporate brokers now and corporate clients such as Awanda, where we provide our education through to their clients as well. As you know, we teamed up with Awanda back in 2013 to provide education programs for their clients too. So the strategies that you'll see this evening are the same strategies that I use on a daily basis myself. Okay, so let's take a look at tonight's agenda. We're going to take a quick look at, or recap, I suppose, of the techniques that we've covered through the program thus far. So we'll be taking a look at mindset and thinking like a trader. And we'll also be looking at price action mastery. We'll discuss the advantages of a clear and decisive trading strategy system. We'll be looking at the two trading strategies that we use, which is the momentum breakout trading strategy and the trend flow trading strategy. And then we'll be taking a look at some of the examples of these strategies in action. So there's some practicals here for you. The idea really through this program is so that at the end of it you have a very good, clear understanding of how these strategies are used, how they're executed, so that you can take these away and start to use them yourselves if you wish. So please don't be afraid to ask questions if you're unsure of anything. Okay, so let's do a quick recap and a quick summary of content that we've covered thus far. So first of all, what we want to do is to focus on our mindset. Trading's not just about trading strategy, it's not just about technical analysis. As a person, we need to think differently. We need to think like a trader. Now, as a trader, it's your job to focus as much as possible on controlling the risk of loss. And more so, much more so than the possibility of profit. Now, many professional traders will focus on risk management much more than the profit that they can make on potential gain of positions. Focusing on profit alone is what new traders or amateur traders, as we'd call them, tend to do. So in order to reduce the impact of emotions on trading, we have to understand that with any strategy, there are always going to be two ratios that we need to take into account. So we have a win-loss ratio, first of all. Now the win-loss ratio is how many trades out of a given sample set, so let's say 100, how many trades out of this sample set will the strategy win, and how many times will it lose on a statistical basis. Now this win-loss ratio is going to be determined by each individual trader. So each individual trader, depending upon how well you execute your trading strategies, will depend upon what your win-loss ratio is for that particular strategy. And that's why you would have heard us talking through the program very much about flawless execution, about flawlessly executing those rules, to the T. And that way, what you're doing is you're making sure that you're applying that strategy correctly and as it's meant to be. The next ratio is the reward to risk ratio. Now for this, what this means basically is for every dollar that you risk, it's what you hope to make in return on average. So in other words, you might risk $1 to make $2, or risk $1 to make $3, for example. Now, some of this can be built into our trading strategy, which we're going to be taking a look at a bit later. Now, as a trader, you need to develop a trader's mindset. That is the proper attitude and behaviors to best support your ability to make difficult trading decisions. So you need to learn the basics like the back of your hand. So what we're going to do is we're going to do a bit of a recap on some of the technical analysis that we use in our trading strategies. So the first one here is the market that we choose to trade. Now, I can't emphasize enough that this is it seems like one of the most basic elements of the strategy. By looking at the trend, by looking at the structure of the markets, but it is one of the most important, and it's one of the ones that I see as many new traders make the mistake of missing a lot of the times. So let me just want to get my pointer visible. So we're going to have trading strategies. We're going to have a concise set of rules in order to be able to execute a trade on a market. The best way that we can start as a trader to give ourselves the best possible chance of the trade playing out is to choose a very predictable market in order to execute the strategy on. So this is where the trend and the structure of the market, the geometry of the market, all come into play. Now, this is what I mean by this. Notice, first of all, in an uptrend, we call an uptrend is formed by a series of higher highs and higher lows. That's an easy term to say. But if we look at this example that we've got here, just look at the clear running, smooth flowing trend that we have. Very decisive higher highs and higher lows. Every time the market makes a new high, it's very easily to see. It's very decisive. We can see these higher lows. They're very decisive ebbs and flows of the market. When we see markets like this, and we see the time frame like this that's nicely structured, then we've got a lot of predictability within this market of how this trend is going to continue. And in which case, these are the best types of markets to start to consider executing trading strategies on. A downtrend here is just exactly the opposite. So, the main point here, the easy part, I should say, is to say that we've just got lower highs and lower lows. But look at the structure of the trend. We've just got very clear, decisive moves. And just taking a look at this, there's no, we don't have to look at it for any more than a split second to be able to see that it's very clear ebbs and flows in the market to the short side. And again, this is one of the things that I focus a great deal of my trading time on, is just identifying the nicest markets with the optimal chart structure to consider trading. When I find markets like this that have got nice optimal chart structure on them, well, then they sit in my watch list for looking for trading opportunities. Okay, so the next one is the trading zones. Now, this is how we use or one of the techniques that we use the moving averages for. So together with the trend, together with the optimal chart structure that we were looking at with the on the previous page, we now want to start looking at how price interacts with the zone, how it interacts with the moving averages. This can give us a secondary measure on the strength of the trend, on the structure of the market. You can see here in an uptrend, what we have is we have our moving averages here on our chart. So all we've got is candles and our moving averages. We have a 10 period moving average, a 20 period moving average, which is this blue one. We've got a 50 period in red here and a 200 period in green. Now, the three moving averages which are the most important is the 10, the 20 and the 50. The 200 is nice to have in the right order, but it's not essential because it is it's indicating the longer term trend. And of course we could have a reasonable move that's where the 200 is not going to be in the right order. So what we look for here is we look for the moving averages to be nicely flowing in the same direction as price, and we see nice space in between them. You can see that they're not crossing over. They were all crossed over here, back at this when the market was fairly flat and sideways. Once it starts to open out and we start to get some momentum behind the market, then we can see the moving averages have opened up. They're nice, clear, nice space in between them, nice geometry in the market, and we can also see that the market's now, the price is just sort of coming into this zone. So we use this zone which is in between the 10 and the 20 period moving average, but it's also either side of it as well. So it's not a precise level, it's just an area where we'll consider other elements of our trading strategies, once price comes back into the zone. What it means basically is that it's a heads up for us to tell us that there may be opportunities around when price comes back into the zone. It means that we stay away from looking at trading opportunities when the price is overextended and more likely to have a retracement. So in a downtrend, we just look at the opposite. So you can see here in a downtrend, we've got our moving averages all in the right order. We've got clear series of lower highs and lower lows. Moving averages all flowing nicely, nice space in between them. And you can just see it sort of happens, on a regular basis. Each time the market comes into the zone, finds new momentum, and the trend continues. Comes back into the zone, finds new momentum, and the trend continues. So it makes sense to start to consider opportunities or look for strategy opportunities when the market comes into that zone. Okay, so the next one is candle size. Now, what we'll find is in many of our strategies we will use the size of the candles. We will look for small candles in our trading strategies. And you can just see here, if we take a look at this trend here, we've got a nice clear trend, higher highs, higher lows. We can see that we've got moving averages all in the right order. We've got the nice buy zone here in the uptrend. And what we can see is that one of the ingredients that we use for the trend flow strategy is to look for a bullish candle in an uptrend. Small bullish candle as price comes back into the zone. The reason is because we bracket this candle to take advantage of the momentum of the trend. So the smallest candle that we can bracket means that it's the tightest risk that we can get on the trade. So we certainly don't want to be bracketing a large candle, you know, maybe something like this, because or this, because the market's got to move an awful long way for us to cover the risk on the trade, to get a one-to-one trade. Bracketing a little candle like this, or like this down here, or like the one that we have setting up at the moment, means that we've got a much tighter risk than the potential reward on that move. In a downtrend, we're just looking for the opposite here. So again, you can see small bearish candles in the sell zone, small bearish candles in the sell zone, small bearish candles in the sell zone. This is an ingredient that we look for within the trend flow trading strategy. Okay, so let's take a look at the next one, which is true support and true resistance. Now, true resistance is when the market has at least two high touches at a specific level within a tick or two of each other. You know, where depending upon the time frame, you might have a, you know, 1 or 2 ticks or 3 or 4 ticks, you know, maybe on a higher time frame. But the more precise the tests of these levels, the better. So we can see here on this piece of price action that the market has at least 2 tests here of this level. Now we've got a level here that's now been identified as true resistance. When the market then sort of comes back up to it and tests it for a third time, we might expect some sort of reaction around it. Now, depending upon the other technical analysis that we have setting up on that market, it might be that we expect a rejection of that level or a continuation, a breakthrough of that level. But what it means is that once we've identified these levels in the market, we can then keep an eye on them. It means that once price comes back up to them, we expect to see some kind of reaction. Now, true support is just the opposite. It's where the market has at least 2 low touches at a specific lower level within a tick or 2 of each other. So again, we can see here on this market's come down, it's tested this level once, it's tested it a second time here, and now it's tested it twice. Well, now that will become on many traders' radar, and they can then see we've now got a third test here and a fourth test before the level finally gets broken. Now, we say that we need 2 tests of a level before these levels become true support and true resistance. The more tests of these levels, the better they become. So the stronger they become, because the more traders observe them more. Okay, so the next one is, the next ingredient that we're going to look at is convergence. Now, convergence is a technique that we use with using a couple of traditional indicators like the MACD and the RSI. So we've got the RSI on this chart here, we've got the MACD on the chart here. Now there's 2 types of convergence. We've got bullish convergence and we've got bearish convergence. Now bullish convergence is when both price and indicators make successive higher highs and higher lows. Now, if we can see here our piece of price action, we've got a clear uptrend, nice clear uptrend here in the market. We've got moving averages all flowing in the same order here. Nice market geometry. We can see each time the market comes into the zone, we get new momentum, the market continues. Now, what we use convergence for is to give us a reading of the underlying momentum within the market. It's to sort of help us gauge whether this trend is still going to continue. We can see that the trend is there, the structure is there based upon the price action and the moving averages, but what's happening behind the scenes? So convergence helps us, or is a technique to help us get a reading on that underlying momentum. And the way we do it is that we look at the significant highs in price. So it's the most recent high compared to the previous high. We look at the MACD down here and the RSI, and we check to make sure that the MACD and the RSI are also making new highs when price is making new highs. So we can see here we've got a higher high in price, we've got a higher high in the RSI, and a higher high here in the MACD. So we can, when we have convergence like this, our expectation is that even when we have a pullback like this, a pullback into the zone, that the trend is still likely to continue. We've still got strong buyer momentum in this market. So still happy to trade this market to the long side as long as we have convergence. Now then we have here bearish convergence. Now bearish convergence is just the opposite of bullish convergence. So again, what we're looking for is for price and the indicators, so price and the MACD and the RSI, to again be agreeing in the current direction of the trend. So we can see we've got lower highs and lower lows in price. We compare the most recent low with the previous low in price, check that against the RSI, and we can see that we've got agreement here. Was each time we've got a lower low in price, we've got a lower low in the RSI here, and a lower low here in the MACD too. So again, it just means that we've got a continued agreement in the direction of the trend. Okay, so let's take a look at some of the advantages of a clear and enumerated trading strategy. So let's recap. Why have a trading strategy? Do you recall the difference between trading strategy and technical analysis? Now, having a trading strategy can help to put probabilities in your favor. It can mean that we build a strategy, we can build a setup that repeats, that has a predictability of repeating a certain outcome each and every time. It helps us to predefine your risk tolerance and exposure on each trade, because risk tolerance and the exposure that you're going to place on each trade should be built into each trading strategy so that you follow those rules every time you place a trade. It helps to develop confidence to select and execute trades. I mean, one of the biggest challenges I think for new traders especially is they see the markets and they see what they think is good opportunities, but how do you know it's a really good opportunity? How do you know that, as soon as you place the orders in the market, that the market's not going to turn around and do exactly the opposite to what you expected? Now, sometimes that does happen, and we don't have, just because we have a trading strategy doesn't mean to say that we've got any guarantees that the market's going to play out in our favor. But what it can do is it can give us confidence that we're following a good, concise, predictable plan. So it helps to reduce the guesswork out of trading. You know, the difficulty is with trading. Let's try and do an example and put it into a different perspective. If you had two traders, one trader that had a concise trading strategy, and another trader who just traded on gut instinct, traded on different set of rules every time he saw an opportunity or saw the market move. He placed trades in the market. Now, the trader that's taken, regardless of what the results are over the course of, let's say, 100 trades, the trader that's used a concise set of rules, a decisive trading strategy, that trader has now got enough data to be able to look back at their trades and build a report on how their trading has been going. How well did that trading strategy follow through? If they need to make any changes to their trading strategy, any improvements, they've got the data to be able to do it. If we've got another trader who's made 100 trades, but every trade that they've taken has just been on a completely different set of rules, and there's no written rules for each strategy that they've taken, and they've got no experience on those, no set of trades against those rules, well, it doesn't matter what those rules were. That trader's not going to be able to know how well that trade has, or how well those rules work for each time. So it's much easier to be able to keep a record of your trades, follow those trades concisely, and then it gives you the data to be able to go back and make any small amendments if you need to. So it helps you to quantify your trading results. So the difference between the trading strategy and the technical analysis. So think about it this way. Have you ever bought a DIY flat pack piece of furniture, cupboard or bookshelf or something like that? Many of us have. And if you have, then you'll know that with every flat pack, piece of furniture, you'll receive all the different components there, and you'll receive the set of instructions. Now, the thing is, without the instructions, assembling the components will be a challenging exercise, to say the least. And you'll have certainly an unknown outcome, that's for sure. Now, in trading, the technical analysis is all the sets of components. It's all the bits of wood, the screws, and all the brackets. And the strategy is the set of instructions. So both the components and the instructions are equally as important. But without one, then the other is not really of that much use. So just checking a couple of questions now. So does Oanda have templates for quantifying the results on the trading strategies? They don't, but the reason is because these are things that you can easily do yourself. And what I would suggest is, when you keep records of all of your trades. You make sure that you follow your strategy rules. So whatever those strategy rules are, if you're using, for example, you'll see our strategy rules shortly. So you'll see the rules that I'll be following for my trades. And then what I will do is I will then be able to do weekly reviews, monthly reviews, 6-monthly and yearly reviews on the success rate of those strategies. I rate every strategy, every trade that I take against the whether it was flawlessly executed or whether I didn't flawlessly execute it, whether there was a mistake made. You can also do things like, if you all your trades that you flawlessly executed, you know that they're concise trades. You can look at things like your your um, your trade management plan, whether you scale out, what your results would be if you'd have scaled out of a trade. For example, whether you closed all your trades out at 1-to-1 or 2-to-1, or whether you closed half your trade out at 1-to-1 and then you scaled the second half of the trade. It gives you the data to be able to make small adjustments like that, and to be able to see whether you were better off with adjusting the strategy and making these fine tweaks. And that's what I recommend. Well, that is what trading is all about. I strongly suggest when you get to that stage that you can consistently do this. And I do this now. I've been trading for almost 20 years, and I always do this. It's you can find out a great deal of information about your trading when you do this, and these small tweaks can have a big impact on your account going forward. Okay, so probability and risk. Strategic trades are constructed. They consist of sound ingredients that, when combined, can improve the probability of a positive outcome over a large sample set of trades. Risk should be predefined before the trade is entered. So we do this by deciding where our entry and our stop loss levels are, and we can see these in advance. Now, once we can find these in advance, then we can make sure that we adjust our trade and that we make sure that we don't expose ourselves to far too much risk on each trade. Now, one cannot guarantee against price gaps and slippage, which are risks of all traders face. And we've got to accept and reduce the risk to the extent possible. So what we're trying to say here is that there's always going to be risks when we're trading in the markets. There's always a risk of something happening that could mean that there could be an adverse reaction to price action that goes against our favor. So we always got to make sure that we cover the downside. Now, the entry and the stop levels should be calculated based on the trade strategy. So those are built into the strategy rules. Now, as we see later, the difference between these levels determines the trade risk that we accept. Now, the position size is then calculated again in advance with your personal risk tolerance in mind. So, for example, a common practice is to follow not to risk more than maybe 1 or 2% of your trading capital on any one trade. So you trade with a very small percentage of your trading capital, and what it means is if you trade with the same percentage, it means that you'll then use that to make sure to help you with your position size, to make sure that you're not oversized on any one position. So we'll take a look at the risk and money management in a bit more detail later on in the session. Now, confidence is established as a result of having a well-constructed and thoroughly tested trading strategy. So knowing the rules of the trading strategy off by heart, so that you know exactly what you're supposed to be doing, what constitutes a setup and what doesn't constitute a setup. Having the competence to execute the strategy flawlessly. We speak about this a lot. It's okay having a set of rules, but then if we've got a set of rules, we need to stick to those set of rules. And each trade only becomes a trade by those rules if it follows all of the rules, not just half of them. So we need to accept the probabilistic nature of trading outcomes. What we can't guarantee the outcome of every trade, as soon as we've executed that orders in the market. But what we can do is we can take trades that have got a probability that each time we take those setups, or each time those setups occur, they have a higher probability of playing out in one direction or another. So we need to make sure that we exercise sound risk management so that the outcome of any trade doesn't make or break an account. So a clear set of rules helps to eliminate doubts and the second guessing within trading. And these factors, unfortunately, are very common with new traders. Now, quantifiable results. Success as a trader does not come from gambling or seeking just the big wins. In the long run, success comes from consistent, repeatable results. The idea is to make money systematically and not just once in a blue moon event. It's no good just hitting the jackpot in trading in 1 week if you can't reproduce it the next week. In other words, it's much, much better to be able to consistently make achievable smaller gains and smaller results out of the market on a repeatable basis. Because once you can do that, then you can start to think that you can actually make a living out of trading. Okay, so let's move on now to the first trading strategy. So the first one is the momentum breakout strategy. And you'll remember we've spoken about lots of elements of this strategy through the program so far. Now what we're going to do is tie this together with a concise set of rules. So this is the strategy rules that we use for this strategy. This is a good screenshot to take if you want to take a screenshot of this one. There's normally a little camera along the top toolbar here somewhere on your screens, and just hitting the camera normally just takes a screenshot of the page and puts it onto your computer, or indeed there's many different sort of software that you can use, like a Windows snipping tool or Snagit or those types of tools, to be able to take screenshots as well. Now remember that a strategy can involve many different scenarios and many different technical factors that can be included to suit the trader. The momentum breakout strategy is just one example of a frequent market occurrence that can be broken down into a list of steps to potentially predict the outbreak itself. The first thing that has to be present is a flat horizontal level. It needs to be tested 3 or more times. The next thing required is that price is trending. It's in a trending market, either making higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. As price is set to break out from the flat level, there needs to be convergence of price and the MACD and the RSI indicator. We need to make sure that there's little in the way of price achieving its desired target by looking to make sure that there's no prior support and resistance levels lurking just between our trade entry and the target. Consider looking at the higher time frames, as support and resistance structures are going to be a lot more clearer on those higher time frames and a lot more apparent, and you'll also be able to see back like much further in price action. You'll be able to see on those higher time frames, you'll be able to see like years worth of data rather than just the recent weeks worth of data. Now, if price is close to the moving averages in the buy or the sell zone, then this would indicate that price has got good potential setup. Today we're going to look for more into risk management, but at this stage, one risk management strategy is to limit your trading capital on any one trade. For example, 1% of your trading capital per trade. So let's take a look at each of these steps in a bit more detail, just to make sure that you fully understand them. So the first one here is that we require a flat level that's been tested 3 or more times. So we can see that the market has tested this level once, it's pulled away, it's come back, it's tested a second time. Now, even though these tests each time, there's been 2 candles that have hit the level, we count this as 1. So 1 hit of the level, pull away, 2, pull away. So that's 2 tests. Come up and hit it a third time, pull away, hit it a fourth time. So we've actually got 4 tests now of this level. Now we can have a lot more, but it's good to have at least 3 or more tests. In other words, we're just trying to identify those stronger levels in the market. The next one is that we want to make sure that the market is within a trend. As this is a trend following trading strategy, we need to ensure that we are trading with the predominant trend, which is why it would be useful to look at the higher time frames. Notice in this example how price has made equal highs under the resistance. So you can see here that we've got higher low, higher low, higher low as the market is compressing up into this level. It's always worthwhile checking the higher time frames as well to be able to see the context of this market and the context of the trend as well. So I'm just checking on the sort of questions at the moment. So which time frame does the so question that's just come through is, which time frames do the strategies work best on, or which P and P1 to use? The strategies, well, the reason we take the time frames off is because they literally work across all different time frames. You're certainly going to find more trading opportunities on the lower time frames, especially with the momentum breakout strategy. So what I mean by this is probably something from a 10-minute chart up to the sort of 4-hour chart. You're going to find a lot more opportunities on those lower than a 4-hour chart, down to maybe a 10-minute, down to maybe a 5-minute time frame, depending upon how low you likely to go, how low you like to go, I should say. For me personally, I tend to look at 10-minute and 10-minute time frames and above. Commonly 15-minute, 60-minute, 30-minute, that sort of time frame. And it's like I say, I mean, we try to take the time frames off because it doesn't matter which time frame you identify the setup on. It's more of this chart structure that you want to see, and then you would look for the next higher time frame. So if I was taking a trade on a 60-minute chart, for instance, then I would use a 2-hour chart as my confirmation chart. So P would be 60-minute, P1 would be the 120-minute. So hopefully that gives you some sort of idea there. If I was trading on a 15-minute chart, then I would be using a 30-minute chart as a confirmation, just as an example. So the next rule that we need here is convergence. Now we want to see convergence of price and the RSI and the MACD, and we want to see convergence on the break of the flat level. So in other words, we can see here that the indicator is moving up, the indicator's extended as price has broken through the flat level. Typically we would see here, as price is flat, we would typically see that the indicators are flat too. So if price moves up, we expect to see the indicators move up too. If the price is flat through here and the indicators are selling off in the opposite direction, then there's no way we're going to have convergence. So we'll take a look at some trade examples a bit later on as well to make sure that that's sort of nice and clear. So number 5 is that we want no support and resistance obstacles in the way of our target. Now, we can't predict whether a trade will have a positive outcome or not, but we need to try and do everything that we can to give it every chance of success. In the example above, the flat level on the trigger chart looks well defined. However, when scaling back to the higher time frames, it becomes apparent that there was prior area of resistance historically. If the resistance is located where you would enter the market and the potential profit target, then you may consider not taking the trade, as the trade is unlikely that the price may find resistance at that level again, and it may not reach your intended target. So the purpose of a good strategy is to stack the factors in our favor, but also to seriously consider factors that are against the trade that may advise against taking it. So, this is why we say check the higher time frames, because checking on the lower time frames, you're just not going to be able to see something, a level that's may have been formed there in the past, and just seeing something there that's a level that's maybe even been created years ago. You often find if price comes back up to this level, you often find that there might be some sort of reaction around it. Now, for that reason, it might then change your perspective on taking a trade. So number 6 is that we want price close to the buy or the sell zone on the trigger chart. So in other words, do you remember how we use the moving averages, how we use these to identify whether the price is overextended or whether it's close to the buy zone? Well, if the market's overextended from the moving averages, like it was here, it's more likely to pull back to the moving averages before there's a new move away from them again. So if price is, like here, compressing up against the moving averages, it's right close to the buy zone already, it's really got nowhere to go. It's got to go one way or the other. And if the moving averages are pushing the price up, it's more likely to push out through the flat level. We've got no wasted momentum, in other words, for price to move up and hit the level at the moment. It's just there now. Not like here, where we wasted a lot of momentum getting up here. By the time it got stretched away from the moving averages, it had run out of steam. It needed to retrace back to them. So having price close to the buy zone here in an uptrend or the sell zone in a downtrend just gives extra weight here that the market is ripe to continue. So rule number 5, if I'm using a 15-minute, which support resistance line would I check, the day or the hour? So let's just go back to number 5. If you were looking at a 15-minute chart here, which you used as your trigger chart, and you identified the 15-minute chart, you identified the flat level here on the 15-minute chart, you would use either the 30-minute or the 60-minute chart as your confirmation chart, but you would also want to go higher than that. I mean, multiple time frames tends to confuse brand new traders, so we use this a bit of with a bit of caution, I would suggest if you are to use as many time frames as you're comfortable with before it's, to make sure you don't get too confused. For example, I would always go up to the daily charts and the weekly charts. I'll always check the daily and the weekly charts just for the high time frame confirmation. Weekly charts, you can see data going back years and years just to make sure that you're not trading into any historical level, for instance. So daily and weekly charts can be very good for those higher time frame analysis, and then you can come down to the more lower time frame, look at your confirmation chart, and then look at your precision or your trigger chart as well for the setup. So hopefully that gives you a bit of sort of tip there as to how to manage the multiple time frames too. Okay, no problem. Okay, so the next thing we want to do is we want to look at our entry and our stop placement for this strategy. So if we look at our example here where we've got a flat level to the long side here, we've got the level that's been tested 3 or 4 times. We want to place an entry just one tick above the flat level. There's no point in wasting any more movement here in price. As soon as price breaks through the level, we want to be filled. So one tick above the flat level is normally where I would place my entry. Now, as these are trend following trading strategies, what I want to do is to make sure that my stop is in a technically protected place. So in other words, what I'll do is come down here and look at the higher lows. So if the market breaks through here, it's now made a higher high. Even if it's just 1 or 2 ticks above, it's made a higher high. So in which case, you can come back down to the previous low, which is 1 tick below the low of this red candle here. This is our technical stop. So 1 tick below the low of this level would be where I'd place my stop. So in other words, if the market made a higher high and then came down and took out my stop, it would then be making a lower low, and in which case the uptrend wouldn't be in place anymore. So I wouldn't want to be trading this market to the long side if there's no longer an uptrend in place. If we come and take a look at the opposite here, so in a downtrend where we've got a low here, we've got one test, lower high, equal low, we've got a second test, lower high again, third test here, so we've got another low. So you can see here that we've now got a level that's been tested a few times. Entry, 1 tick below the level. Same principle, I place my stop 1 tick above the high of this candle here. Just meaning that this is the lower high, lower high, lower high. So again, if the market triggers me into the trade, it's now made a lower low, and I'm in the trade. If it comes back up here, takes out this high here, well then it's now made a higher high. So no, the trend is no longer in a downtrend. So this is the technical place to place the stop. Okay, so let's take a look at a trade example here, and then we'll take a short break. So we can see here, this is actual fact, this is one of my trades, which was taken some time ago. It's a dollar yen. It's on a 15-minute chart. We've got a level through here that the market, as you can see, has tested a few times. It's been resistance, been support. It's been support many times here. We've got lower highs as the market, so we've got lower highs and flat lows. So certainly got more than 3 times tested on this level. Major trend is to the downside. We can see that this is the MACD here. We can see the MACD is flat. whilst price is flat. So is the RSI flat as well. Below this level, we can see, well, there's probably nothing in the way until we get down to these old levels down here. So there's certainly plenty of movement to the short side before, price reaches any sort of historical lows. Price is very close to the sell zone. Moving averages are just in here at the moment. Stop, a nice place to place our stop would be just above these highs up here. So now we've got a place for our stop and we've got a place for our entry. And the way that we would do our targets is we would then measure the distance between our stop and our target. So let's assume, I can't remember what this was now, but let's assume that this is 20 points. Then first target would be 20 points, second target would be 40 points, third target 60 points, etc. So this is how this particular trade played out. Eventually, the market got triggered into the trade. We can see moving averages all fanned out in the right order, and the market came down. First target reached, and then it started to continue further. So you can see, is exactly how we want to do it. Equal distance to risk reward. Okay, we can take a look at some more examples, trade examples, a bit later on. What we're going to do now is just take a short break because we've been running for an hour now, and what we'll do is we'll take a 5-minute break. So this is London time, and if we just take a break to, if I can draw with my mouse, 20:07, that will give us 5 minutes, enough time to get some refreshments and get a drink, and then stay focused for the second half. So I'll pause it and we'll be back in 5 minutes. If you've got any further questions, by the way, please feel free to pop those into the questions box over the break, and I'll cover those before I move on. Okay, speak to you shortly. Okay, so let's take a start again now, and we'll take a look at the trend flow trading strategy now. Okay, so just as I've been paused, can I just do another quick sound check just to make sure the sound is still coming through at your end? Fantastic. Okay, that's good. Thank you very much. Okay, so we can take a look at the trend flow trading strategy now. Now, this strategy is designed to take advantage of these more smooth flowing trending markets where we get nice ebbs and flows, and the market just seems to be trending in, just sort of flowing nicely in one direction or another. So again, this is the strategy rules for the trend flow trading strategy. This is probably, if you want to take a snapshot of these rules of this page, it's quite a good one to take, and then you don't need to write anything down. Now, the trend flow strategy can be broken down into a list of steps that are simple to follow. We will look at each one of these steps in more detail in the coming slides. Again, it's important to remember that this is a sample of a strategy, and it might look, that a trader might like to take. There are many ways to bake a cake, and there are even more ways to go about trading the markets. Now, this is one way, and it shows how some of the technical ingredients we covered in the last few weeks of the sessions can be combined together. For us to say that this is the only way to trade would be like claiming there is just one recipe to bake a cake. In fact, we all know that there are many ingredients, flavors, and combinations, and this example is just some of the common ingredients that we use combined. So this is, as we're trying to say, this is our strategy, but it doesn't necessarily have to be the only strategy. So what we're looking for is that price is trending on the setup chart. We want moving averages to be correctly aligned. We want price to be in the buy zone or the sell zone. If it buy zone in an uptrend, sell zone in a downtrend. We want a small trigger candle that forms bullish in an uptrend or bearish in a downtrend. We want the RSI and the MACD to be convergent on the trigger chart. We want to check the confirmation chart, make sure there's no support or resistance obstacles in the way of target. We want to strongly consider capping your account risk to levels that are acceptable to you and for your investment criteria. So we'll cover that a bit more later on. So let's take a look at the rules illustrated individually. Now, what we want is, this is a trend following trading strategy. We need to ensure that we are trading a good trend. Now, this trend should represent on two different time frames. In other words, price needs to be making either higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend on two separate time frames. Now, the trend following trader will assume that the trend will remain true until it ends. So we can see here, and remember what I suppose the tip here is that I can give you is, remember what I was talking about with optimal chart structure. With this particular strategy, you want to identify these nice smooth flowing markets where we've got very decisive highs and lows, in an uptrend, or lows and highs in a downtrend. Once we've got these decisive, very nice, clear, decisive, higher highs and higher lows in an uptrend, then we can look for opportunities of where we can start to, look at where these decision points, where these pullback and turning points are likely to be. So the next ingredient that we need is we need to have our moving averages all fully aligned with price. So we can see our price action. We want to see our moving averages all in the same order, all following in the same direction as price, with nice space in between them. We call this nice moving average geometry, all flowing very nicely in a fanning action. Number 3 is that we want price to be in the buy or the sell zone. So in other words, in an uptrend we want price to be in the buy zone, in a downtrend we want it to be in the sell zone. So we can see here, each time price comes back into the zone, it just comes back into the yellow, we see price finds new momentum and the market continues. Number 4, after price has pulled back to the zone, we would need to wait for a small candle to form in the zone. Now in this example, you'll notice that a small bullish candle is occurring now, right at this area here. So we'd wait for the candle to close and then it would become our trigger candle. So the smaller this candle is, the better, because it will mean that it's going to determine our reward to risk, since your entry and your stop loss will typically be dictated by the size of this candle, and we'll demonstrate that shortly. The next thing is that we want to see convergence with the RSI and the MACD. So as price continues to trend, we need to see that the indicators are trending in the same direction too. In this example, as price makes a new high, the indicators follow suit. Just indicating that there's still buying momentum in this market, so we'll still be happy to trade this market to the long side. Now, number 7, we need to make sure that there's no likely resistance levels blocking our target. Again, we check this by taking a look at the higher time frames. We check for prior resistance levels and significant round numbers between our trade entry and our desired target. This likely resistance level, could potentially hinder our trade from reaching its profit target. So we'd need to consider foregoing the trade if there's resistance ahead of the desired target. Remember, a good strategy not only considers the factors that help the trade, but also the factors that are likely to hinder it too. So let's take a look now at our entry and stop placements on this strategy. So the guidelines for trade entry are kept quite simple in this strategy. For an uptrend, we would need to wait for a pullback into the buy zone and enter 1 pip above a small bullish candle, plus half the spread. The stop, 1 pip below the candle, less half the spread. As mentioned in the chapter on momentum breakout strategy, we would consider limiting our overall risk to an acceptable level. For example, 1% of your trading capital on any one trade, or whatever your percentage risk is. We'll be entering on buy stop on a long trade and sell stop on a short trade. Now, these orders, as we're entering at a price which is worse than the market price. So you can see here that as the market comes back into the zone, we're looking for exhaustion of the pullback. So we can see now that pullback's coming into the buy zone. We've now got the first bullish candle here. We've got the first bullish candle indicating a buying momentum coming back into the market. So we'll look to place our stop 1 tick below the low of the candle here, entry 1 tick above the high of this candle. When the next candle triggers, if it moves up, breaks the high, we'll be triggered into the trade. If it comes down and it breaks the low first, well then we void the trade We take our orders off the market because we haven't identified the turning point in the market. In other words, it's still going to continue to retrace. If the market continues, or we get entered into the trade and it continues higher, then our anticipation is that the market is going to make a new high. So it's got to make a new high above the previous high. So that gives us a distance in price in which we can consider trading. The opposite is just true for a downtrend. So we can see we've got a downtrend here. We've got our low, we've got a lower high, lower low. Markets come back into the zone here, into the sell zone. So we look at this as a potential lower high. We've got a bearish candle. We look to place our stop just one tick above the high, our entry one tick below the low of this candle. It'll be the next candle that triggers us into the trade or voids the trade. Again, if we get triggered into the trade, we've then got our stop in a technically protected place above the swing high, and we'll be trading this market down to the old lows and maybe beyond as well. Okay, so we've got an example here of the trend flow trading strategy. So this is a screen print of an example trade on the 1 hour chart of Euro AUD. So let's assess this for a potential trend flow strategy setup. So we've got the checklist down here, and this is how we use the strategy checklist. So we look at the market, we want to just work through the rules and make sure that we've got all of the rules setting up there. So have we got price making, higher highs and higher lows? Well, we can see that we've got a nice trend here. Got a nice clear series of higher highs and higher lows in the market. We've got our moving averages correctly aligned. So all of our moving averages are all in the right order here, even the 200. Nice, they're not crossing over, they're nice moving average geometry here, all flowing in the same direction as price. So we can see, is price in the buy zone? Well, we can see each time price comes back into the buy zone, finds new momentum, and the market continues. Each time it comes back into those averages, and we're right there at the moment, as markets just retraced back into the 10-period moving average. Next one is, have we got a small trigger candle? Well, we can see just here, we've got small green bullish candle appearing in the buy zone, just on that 10-period moving average. So the next thing we want to see is the MACD and the RSI convergent with the trend? And we can see, well, we've got clear higher highs, higher lows here, clear uptrend in price. MACD making new highs, trending with the price action. So is the RSI as well, continuing to make new highs. So we've got convergence with the MACD and the RSI too. So we've got all of our rules setting up here on Euro AUD on this 1 hour chart. So this is the trade example, or this is this trade actually played out. This is the result of this trade. The trade actually continued to run, and you can just see, you see how many, this is why we look for a small candle, because you can see how many targets we would have reached in this trade as the market continued. In fact, I mean, this was another one of my trades, and I got out up here somewhere actually. So there was a number of targets by the time it got up to here. I didn't wait for it to come up here. So again, you can just see, but you know, regardless of this one, you can just sort of see back here, you know, there was probably even a better setup here, or an even better setup here. So you can see that these sort of patterns and the rules are repeatable. You know, they're repeatable all through time and different markets too. Now, while we're showing you a positive result here, the outcome, remember, is not known when placing the trade, and that's why we've got to make sure that we use a stop loss and good risk management as well to limit the downside. So in the instances where the trade goes against us, we need to make sure that we're not going to lose too much of our trading account, on those particular trades. Remember that accepting and managing losses is part of trading. Okay, so what we're going to do now is we've now gone through the strategy rules. We've been through the ingredients throughout the course of the program, and now it's time to put that learning to the test. So we've got some trade examples coming up, and what we want to do is these are live practicals, so this is where you can test your understanding and test your learning. So take a look at trade 1. Is there a potential trade here on this market? We've got Euro Swiss, a 2-hour chart and a 4-hour chart. So we got the lower time frame and we've got the higher time frame. So I'll give you a few moments to take a look at this. Drop your answers into the questions box. I want to know what strategy you would be considering here. Is there a trade set up? And if there is, what strategy would you use? And what direction? Would it be long or short? So is it a momentum breakout strategy, or is it a trend flow strategy, and is it long or short? Is there a good trade here that you would take, or isn't there? So to consider, if price is trending on the setup chart and the higher time frame, have we got trend confirmation? Are the moving averages, are they correctly aligned, and are they fanning? Is price in the sell zone on both time frames? Is there a small bearish candle? Is the RSI convergent on both markets, on both time frames? Is the MACD convergent on both time frames? Is there any support and resistance in the way of price reaching its potential target? We'll take a look at the higher time frame. We'll take a look at the daily chart on the next time frame. So we've got a lot of people coming through saying yes, they would. Yes, there's a trade. It's a trend, and you would sell. The trend flow short, you would take the trade. Good, good. So there's a lot of elements here that we've been discussing. We've got the trend, lower highs, lower lows, lower highs, lower lows. Markets come back into the sell zone here. We've got bearish candle on both time frames here. We've got convergence on the indicators. We've got nice convergence there too. Let's take a look at the higher time frame. So this is the daily chart. You can see here on the daily chart, we're in a nice downtrend on the daily chart too. So solid bearish trend on the daily. We've got support at 1.2185. So you can see that there's just a nice trend to the downside. Price is just finding resistance, at this level. So nice trend flow trading strategy to the short side. Okay, so let's take a look at the next one then. This is trade 2. Now we've worked through the first one. So with this one, everything is on this page. So I've got no additional time frames to show you. So take a look at this. Is there a trade setting up here on this market. So this is Euro Yen. We've got an 8-hour chart over here. We've got the daily chart, which is the higher time frame over here. So I'll give you a few moments. Take a look at this. Tell me whether you think there is a good trading strategy setting up here, and what the strategy you would use, and whether it's long or short, and whether you would take the trade or not. So some good interesting answers coming through. This one's a little bit more tricky by the looks of it. I'm getting a mix of answers. So probably got about 50-50 answers here. About 50% of people are saying they would take the trade. They would take it long. About 50% of people saying they wouldn't take the trade. Some people are saying they'd take it on the small bullish candle. So one of these. What's the trading strategy here? Is it trend flow or is it momentum breakout? What would people use? Okay, that's good. So we've got a lot of pretty much everyone saying now trend flow. That's good. Okay. Right. Let's take a look at this. Let's work through this one then. So this is our trigger chart or our position chart. This is our higher time frame. So the first thing we want to establish is, have we got a trend? Well, we can see here on the trigger chart, we've got a clear trend here. High, low, high, low, high, high, higher, low. So we've got a clear trend there. Again, take a look at the higher time frame. Again, we've got a very consistent trend here. Nice clear series of higher highs and higher lows. Come down to the moving averages. We've got all the moving averages in the right order as well. So all of those looking very nice. Nice market geometry. Each time the market comes into the zone, moves on, makes a new high. Comes into the zone, moves on, makes a new high. Back in the zone at the moment. Exactly the same here on the higher time frame. Each time it comes into the zone, finds a new high. Back in the zone right at this moment. Have we got a small trigger candle? Well, these ones in here, we've got a number of little candles in here. These are probably, I'd say these are probably average. They're certainly not large. I wouldn't say they're small either. We've got smaller ones just here, smaller ones just here, for instance. But they're certainly not large, so they're average. So it's going to be just okay. We've got small here on the daily chart though, which we would, if we were taking this trade here and we were bracketing these candles, we would also be bracketing this candle here on the daily chart too, and that looks much nicer. So we got the trigger candle. The next thing, have we got convergence on the MACD or the RSI? Well, when we come down and take a look at the RSI and the MACD, whilst price is making higher highs, so we check, if you remember how we do this by checking the recent high with the previous high. We can see the recent high to the previous high, we've got divergence there. And we've got divergence here on the MACD. When we come up to the higher time frame, we haven't I'd say they're probably equal rather than divergence. They're probably equal, but we certainly got divergence here. And this was one of the rules of the trading strategy. We can't see any obstacles in the way of price reaching its desired target. Certainly if the market continued higher, well, if it made a new high, we would have a target in here. That wouldn't be a problem. It'd probably be just above this previous high here by the time we get to it. But the fact is that we've got this divergence here. If we remember what divergence means, it means that there is potential weakening momentum within this setup. So it's, our expectation is that the strength of this uptrend is coming to a pause, or it's maybe taking a bit of a breather. So for that reason, this setup wouldn't comply with all of those strategy rules because we got this divergence here. So it's a good one to put on our watch list and keep an eye on, because if this divergence plays out, then otherwise we've got a lovely market here to consider new trading opportunities. And look how long this market has been running. We can see that this trend has been nice optimal chart structure for a long time. So we'd certainly want to keep this one on our watch list, but maybe we'd be very cautious about taking a trade here if we're actually, well, it's going to be breaking our strategy rules, taking a trade using divergence. So well done for all those people that actually spotted the divergence here and didn't get sort of mesmerized by all of the good points that were here on these setups. And this is one of the things why we use these strategy rules and the strategy lists, because it's very easy to take a look at a chart and think that looks really nice. And you look at all the good things about it, and you forget about the things that are not quite right. They're not things that are not quite there, that don't quite comply with all the rules that we've set aside for ourselves as trading. So, very good. Let's take a look at the third trade now. Now, third trade, again, I've got everything here on this chart. So we've got 2 time frames. So now we've got P and we've got P1. So P, our precision chart, is here on the 30-minute chart, and P1 is on the 1-hour chart. So this happens to be SGD against the Japanese yen. Take a look at this market. Tell me what you think. Have we got a good setup here? Is it a trade, potential trade here? If so, what strategy would you use and which direction would you go? Is there anything here that would concern you? Anything that would keep you out of place in the trade? If so, what would it be? So I'll give you a few moments to take a look through this. So I've got a lot of good answers coming through already. I'm not going to read them out because I want everyone to have the chance to take a look at this and see for themselves. I think everyone's coming through with the same strategy, so that's good. Okay, So let's take a look at this one. I've got lots of answers coming through. So given the distance of price from the P zone, from the zone on P1 and P2, this isn't a potential trend flow setup because we're too far away from the zone, as we can see. However, it does appear that price is making a flat level on the precision chart through here that's been tested a few times. So if we take a look at the momentum breakout strategy, and we can see what else we've got setting up here. So if we've got a flat level, we need to have it tested 3 or more times, and we've certainly got probably at least 3 tests through here. Probably 1 test here, 2 tests here, 3 tests here. So price is in a confirmed downtrend. We can see that. We've got lower highs, lower lows. We can see that from the higher time frame. We've got a nice downtrend too. Next thing we want to see is we want to see convergence of price and the RSI on the break of the flat level. So in other words, if the price makes a new low, if the price moves down, we'd want to see that the RSI also moves down and the MACD. And we can see that whilst price is flat through here, so is the RSI, and so is the MACD as well. So we've got convergence on our indicators too. So if we also take a look, well, we can't see the historic data here on the chart, but certainly, you know, the best place, let me get my pen here, if I can draw a flat level through here, that's not too bad. The way I'd be looking at trading this would be a stop above the high. So we've got lower high here, lower high here. So there's our trade risk. So probably first target's going to be somewhere around here. So it doesn't look like we've got any support and resistance in the way of target from what we can see anyway. We can also see that price is not far away from the sell zone at this moment in this chart. It's certainly been a lot further away here, and it's drifted sideways. Exactly what's happened here. So what we have got here is we've got a good setup here for a potential momentum breakout trade to the short side. So should price break through this level through here, be looking at trading this market to the short side. So well done, well done. Let's take a look at the next one here. Now, this is just a little bit different, and I want to show you some things that can potentially occur, some things that can potentially set up here. So take a look at trade number 4. Again, this is all the time frames that we have here. So we've got 3 time frames here on this chart. Tell me what you think. Is there a potential trade set up here? Would you take it? What strategy would you use? And which direction would you trade the market? So I'll give you a few moments to take a look at this. So we've got some strategy suggestions coming through. I won't read them out just yet. Okay, so let's take a look at this. Now, this is what, so just checking the questions. Okay, so this has definitely created a bit of confusion. Now, what I want to suggest here is if we just take a look at what we've got and talk about each time frame. So here on P2, we'll talk about the higher time frame first. We've got clear uptrend, higher highs, higher lows. Price just come back into the buy zone here, just coming into the 10 period moving average. Moving average geometry, all very nice, perfect. Lovely moving average geometry, all flowing in the same direction as price. Got convergence on the indicators too. So we've got agreement with the current direction of the trend. So P2 is a good confirmation chart. Let's come down to P1. P1, got nice clear trend, higher highs, higher lows, moving averages, all in the right order here. Got convergence on the indicators, the MACD and the RSI. Price has now come into the buy zone, and now we've got a small green bullish candle here right in the buy zone. So for those of you who have said to me that you would take this as a trend flow trading strategy here on P1 and use your P2 as your confirmation chart, absolutely fine. You've got a trend, and that's correct. You've got a trend flow strategy setting up here on P1, and you're using P2 as your confirmation chart. If we come down to P then, which is a lower time frame altogether, now this actually confused people because the moving averages have crossed over, because the market's had a much deeper pullback on this time frame. So this started to get a bit of confusion here. And we haven't got the moving averages all in the right order here. But what we have got is the context of an uptrend. We can see that we've had a deeper pullback, but we've got the confirmation of the trend here on the higher time frames. We've got a bit of a, let me just get my, if I could draw a flat level through here, something like so. You can see that we've got a level through here that's been tested a number of times. From our low, we've got, a high. We've certainly got sort of higher lows here in the market. If the market breaks through here, then we've got a higher high as well. If we come down here to the MACD and the RSI, well, we've certainly got, whilst price is flat, we've got the MACD, it's the RSI and the MACD now flat. So it looks like if price did break through the flat level, it looks like we'd have convergence here on the RSI and the MACD. So to answer the questions, yes, we've got a trend flow trading strategy setting up here on the P chart. We've got a trend flow setting up here on the P1 chart. We've got here on the P chart, we've got a momentum breakout setting up here with the confirmation of a trend flow setting up on P1. So it's just one of those nice setups where you've got two strategies setting up on the same market, just on different time frames at the same time. And sometimes you do see this. And they're just nice, strong setups when you do. Okay, let's move on to take a look at number 5. We've got 7 trades in total to work through. So with number 5, we've got the P chart is a 2-hour chart on Aussie Kiwi. The P1 chart is the 4-hour chart. I've also got an 8-hour and a daily to show you as well. So I'll show you those in just a few moments. I'll give you time to take a look at these 2 time frames. So again, the question is there a potential trade set up here, and would you take it? And in which case, which strategy would you use, and which direction would you trade? Again, a few mix of answers at the moment. Okay, so let's just take a look through this. So here on P, we've got trend, lower highs, lower lows, lower high, lower high, moving averages all in the right order. Price just come back into the sell zone here, small bearish candles in the sell zone. If we take a look at the RSI and the MACD, we got slightly divergence here on the RSI and sort of slight divergent, well, probably flat actually, probably flat MACD because we're comparing this low here to this low. So this low here to this low, probably got a bit of convergence there actually on the MACD, but here on the RSI, we've got a low, a slightly higher low, so a bit of slight divergence there. If we come to the 4-hour chart, we've got trend, small candles in the sell zone, moving averages in the right order. We've got convergence this time on this time frame, so now we've got convergence. Let's take a look at the higher time frame now. So now we've got the 8-hour time frame and the daily time frame. So now we're just adding more time frames, more opportunities to do more analysis on this market. So high time frames, P3 is the daily, so we can see that as we're trading in the direction of a daily trend as well, so the daily trend is gain, it's in a nice solid downtrend, strong moves to the short side. Again, we're just trading with the overall momentum of the higher time frame, so much higher probability trading with confirmed trends on these higher time frames. So again, what I'll be looking at here is, because the market, because what we've got here is downtrend confirmation on the daily chart, here on the 2-hour chart we're a little bit overextended from the moving averages. I'd be expecting a bit of a pullback here before looking for opportunities. So let me just go back to the lower time frames. The best time frame I like here is P1, but I can't use P1 as a setup because P2 was overextended. So I couldn't use this was the one that actually had all the ingredients setting up here in P1 as a trend flow short, but using the higher time frame as a confirmation chart, it was too overextended. Remember, it didn't actually comply with all of those rules. So, for me, this would be one that I would be no trade right now, but I'd put on my watch list, and keep an eye on this for future opportunities. So this bit of divergence would start to concern me a little bit. When I see this, what I tend to do is just to move up to the higher time frame. So you can see here on the higher time frame, we don't see the divergence, which means in the bigger picture, we're still looking like in a downtrend. But of course, when we got to the higher time frame, even still looking for confirmation, well, we didn't quite have it. So, that's this is the benefit of having rules. So we've got 2 more to take a look at this evening. So let's take a look at number 6. So number 6, this is all the time frames I've got for this one. So take a quick look at this one. What do you think? Have we got a trade set up here on Great British Pound against the Canadian dollar? If we have, what trade strategy would you use, and what strategy would you use? Which direction would you trade? Would you take it? Remember, the benefits of having concise trading rules is that when you refer to them, it doesn't necessarily mean that they're always going to be there. So I'm getting lots of decisions coming through at the moment. And they're all the same decision, which is good. And exactly, I mean, everyone who's answered, everyone who's replied has said no trade. They wouldn't take the trade. Perfectly correct answer. You know, the best setup that we have here is on the 8-hour. Chart structure looks the cleanest. We haven't got a bullish candle at the moment. We've got a small bearish candle in the sell zone. We've got divergence here on the indicators. Coming down to the 4-hour, well, we just don't have optimal chart structure here at all. Yeah, we've probably got maybe just a higher high here, maybe just a higher high. We've certainly got higher low, but look at the price. It's pulled back right beyond the buy zone. The moving average is crossed over here. They crossed over here again. We haven't got that clear structure that we need to see. There's no flat level here, so there's no momentum breakout. It has to be a trend flow. There's no trend flow setup. So that's a pass. So well done for everyone for answering that one. Okay, so this is the last one that we have this evening. This is number 7. This is New Zealand dollar against the Japanese yen. We've got a 2-hour chart, a 4-hour chart here, and I've also got some higher time frames to show you on the next slide as well. So what do you think? Have we got a strategy set up here? Is it is there a setup here that you can identify? Would you take the trade, and in which direction would you go, and which strategy would you use? So we've got lots of answers sort of coming back, but I think more concern, I think, coming through looking at the questions rather than the sort of decisive action that I've had with the previous slides when we've had very decisive decisions. Now think about, for those of you who are answering me, think about what you're saying to me. Think about, you know, in previous slides, previous trades, you gave me a decisive answer of what strategy you would use, whether you would take the trade, and you told me which direction. And now virtually everyone is answering with indecisive answers. You're not sure. And I'm in total agreement. And the reason I make that point is this. When you scan through the markets, when you're looking for nice, clear trading decisions, they should jump out at you. You've got the strategy rules. You look through those rules. They should be there, obvious. When you start to have to look at the markets and start to consider, well, have I really got a setup here? Is this really good enough? You're normally answering your own question. This one doesn't look particularly promising, to be perfectly honest, on these time frames. I mean, we can see here that Some people are saying that there's a momentum breakout here. Remember, what we like to see with momentum breakout is we like to see, the market come up, test the level, get my pointer. We like to see the market sort of come up, test the level, pull back, test the level, pull back, test the level, pull back, test the level again. All we've got, I can't draw a flat level there. If I could draw a flat level, it's not really, we haven't really got that. Some people are mentioning the size of the wicks on these candles. Moving averages have just met up here as well. We've got our high there, we've got a lower high here, so we haven't really got the trend looking particularly great. Here on the higher time frame, we've got our high, we've got a low. Again, well, we don't have a flat level here on the 4-hour chart. It's just lower highs here. We don't have a bullish candle here in the buy zone, so it's not looking particularly promising. So let's take a look at the higher time frame. So here on the higher time frame, on the now we can see the daily chart and the weekly chart. So the high time frames, especially the weekly, show that there is some overall upward momentum and a trend worth watching. Certainly this weekly chart does look particularly nice structure, especially around this area here. However, the daily is overextended from the zone at the moment. Remember where the daily is at the moment. This is the little green candle where we are at the moment. Quite overextended from the buy zone here. And we also took a look at the issues that we raised with the lower time frames as well. So this is one that, for me, what I would be doing is putting it on my watch list and keeping an eye on it for future opportunities. But at this moment in time, the setup is not quite good enough there for me to consider trading. And I think pretty much everyone who answered had got some sort of concerns there over the structure of the markets in one way or the other. Heavy wicking, no bearish candle, big wicks. Some of the comments that have come back. No bullish trigger candle, divergence. What else have we got? Some people want to see the higher time frames. We've just taken a look at those. So you can start to see now we've taken a look. My advice is the ones that if they're not clear, then we keep an eye on them. Keep them on the watch list. The ones that are clear and they're decisive, they're the more simpler ones to take. Okay, let's move on. So probably going to run over by about sort of 5 minutes. I've probably got about 5 minutes worth of slides just to finish off. So let's take a quick look at money management and account risk. Now, every time we place a trade, we open ourselves up to risk. Now, the risk of losing money, losing our trading capital. Now, this risk, we can all account risk. We can control how much we place on at risk on each trade by setting our stake or position size according to the amount of capital in our trading account. Now, as you know, and what I've mentioned earlier is that we personally set our account risk to around 1% of our trading account. Now, if you've got a particularly small trading account, you might need to increase that slightly. But whatever it is that you are prepared to risk on each trade, you should make sure that you define that in advance. Account risk is referenced in terms of dollars. So, for example, dollars, pounds, yens, whatever the currency is that you're trading in your trading account. So, let's just define what we mean by risk here. So we have money management risk, which is our trade risk. Now, trade risk is defined as the difference between the entry price and the stop loss price. So on our breakout trade here, we had the distance between our entry and our stop down here. This was our trade risk. For example, in this example, the difference between 1.6745 as our entry and 1.6695 equals 50 pips. So that's what our trade risk is going to be. Our example here in a trend flow trade, the difference between our entry and our stop, entry being 1.3155 and our stop being 1.3255, means that we've actually got a trade risk of 100 pips in this particular example. Now, let's now take a look at position size. So in order to calculate the trade's position size, or the number of units that we're going to trade, we need to use the account risk and trade risk. So let's use an example. So if we have a trading account of, say, 10,000 US dollars of trading capital, and we decide that we're going to use a 1% risk parameter. So if we take a look at our breakout trade here, we've got a trade risk of 50 pips. So we take 1% of $10,000, which is $100. So now we know that we can risk $100 on this trade. So our trade risk is 50 pips, because that's the difference between our entry and our stop. So our position size is $100 divided by 50 pips, which equates to 10,000. So in other words, the number of units that we can trade is 20,000 units. So that makes sure that we're using the right amount of trade risk for the particular trade according to our account. So we spoke a little bit about trade management earlier, but if we take a look here, we were looking about how we manage the trade once we're in them. So we've got our stop down here, we've got our entry here, we've got this distance, which is our trade risk. Now, there needs to be a minimum reward for accepting the risk in the first place. Now, many traders would aim to achieve at least a 1-to-1 risk reward, if not greater. So in other words, they risk 50 points or 50 pips here on the trade. They want to make at least 50 pips on the trade, preferably more, maybe double, maybe 100 pips. In other words, for risking $100, there should be a minimum of $100 return. Now we can use trade risk to determine our profit targets as well. So all we do is we just double our trade risk to define where our profit targets are going to be. Okay, so for the past 4 sessions, we've worked through our technical analysis, we've worked through a number of techniques here that we use in our trading every day. And today we've now just gone through the trading strategy rules and taken a look at those strategies in action. So this concludes the Oanda Premium Education Program of Forward Thinking Traders. So we looked at the technical analysis, the ingredients, the trading strategy, which is the instructions or the recipe to trade these ingredients. Now there's many technical ingredients that a trader has at their disposal that you can include in your trading strategy. And what we've done is we've covered some of the major ones in the Forward Thinking Traders course. Now the trend flow and the momentum breakout examples are good trading strategies that we utilize ourselves on a daily basis, but doesn't mean to say that they're the only ones that you can use to trade. Traders will use many different, there's many different ways to trade the markets. This is just our way. Now, money and risk management are vital components of any good trading strategy, whatever trading strategy you decide to use. Now, as with other professions or endeavors, the one thing that is common is that it's experience that's required to become competent, and it's exactly the same in trading. So my advice is, if you're brand new to trading, is to study the trading programs, study the trading strategies, and if you're a client with Oanda, then of course you can attend the program as many times as you like until you become really fluent in the analysis and in the trading strategy rules. Now, I'd like to just draw your attention to the other webinars and education that we run here at Oanda. We run a series of live market programs. So you can take a look at market commentaries that we run twice weekly, and these are placed into YouTube. So this is one of the Trade with Precision team will be doing some analysis on the markets that they're keeping a close eye on at the moment, and it's placed onto YouTube on a Monday and a Wednesday. So you can just check this out by going to youtube.com/Oanda. You can subscribe to the YouTube channel, and then you'll be notified as soon as those YouTube's videos are placed up. Now, the market commentaries, as I say, there's two of them. They're placed up on a Monday and a Wednesday. Okay, so we've come to conclusion of this evening's webinar. So what I'd like to do is just to take a look at some of the questions that are coming through, and I'll answer those in just a few moments. If you've got any further questions that you would like to ask for Oanda, then please feel free to contact Oanda. You know that they're there any time of the day or night now, and you can contact the most local office to you. We also run, and like I say, we run a number of programs for Oanda. There are, second to running through the Forward Thinking Traders program again, we actually run Forex in Focus, which is a live market analysis webinar. So 1 hour webinar, we run that on a periodic basis, where we will actually go into, one of our traders will go into the live markets, and they will show you some of those unique features of the trading platform, the